If you are a successful real estate investor, I'd like to tell you why you should consider an indexed universal life insurance contract. Now, this isn't a matter of changing your investment strategy or philosophy. This is more about protecting what you've accumulated. I'm John Havey with Life Legacy, and I'd like to show you how you can protect your wealth and make it liquid, safe, and protected from market volatility. So this is a critical financial strategy for successful real estate investors who have built wealth through property investments. But here's the question that many seasoned investors are asking themselves. Is keeping 80% or more of your wealth tied up in real estate still the optimal strategy for this stage of your life? Now, the strategy that built your wealth may not be the same one that you should pursue. I want to introduce you to why many successful real estate investors are moving up to 60% of their assets into an indexed universal life insurance contract. This isn't about abandoning real estate completely, but it's about strategically repositioning your assets to better align with your current life stage and financial goals. As you enter your 50s and 60s and beyond, your financial priorities shift typically towards preservation, liquidity, and simplification, not to mention tax efficiency. So when it comes to preservation, you want to protect the wealth that you've worked so hard to build, and you have less time to recover from any significant losses or market downturns. When it comes to liquidity, you want to be able to access your equity very quickly because you'll need it for your day-to-day retirement desires or healthcare needs, maybe family support, or any type of lifestyle adjustments. And then simplification. Many investors find themselves wanting to reduce the complexity and demands of managing properties, and we know the challenges that can come with that. And then tax efficiency. So minimizing the tax burdens both on income and estate becomes increasingly important. And I'm going to show you how you can avoid taxes for your retirement years. So real estate may not optimally address all of these shifting priorities. Let's examine why. So first is market volatility. While real estate often appears stable, with the market turning down, like we saw in the 2008 housing crisis, we can experience the kind of change that would take time for the value of your holdings to come back. So we want to avoid market volatility if we can. Next is liquidity constraints. Now, if you've been in real estate for any amount of time, you know that real estate is nice for the equity that's available and pulling that out for either other investments or just for living. But converting that property to cash quickly often means accepting below market prices. You're at the mercy of whatever the rates are, maybe your credit rating, and how leveraged you are with your holdings. And of course, management burden, I think that speaks for itself. Changing tenants, repairs, maintenance, those all have their own challenges that I don't need to discuss here. You're familiar with those. And then tax inefficiency. So this is a big one, but most of the real estate investors that we work with don't understand the benefit of moving their holdings to a financial vehicle that does not have the same tax consequences. So the income from rental properties obviously is subjected to ordinary income tax and, of course, the yearly property taxes we have. And then there's always estate complications that need to be considered. Properties in your estate may need to be sold quickly to pay taxes at inopportune market times. So just to be clear, I'm not suggesting that you abandon real estate entirely. What I'm more advocating is a balanced approach that addresses the risks while preserving the benefits that real estate has brought you. And specifically, we're speaking about the retirement years when you don't want to be exposed like you were when you built up your portfolio. This is where the indexed universal life insurance contract comes into play. And it is our favorite financial vehicle for those who are preparing for retirement for several reasons. An IUL is not just insurance, it's a sophisticated financial tool, particularly well suited to the needs of successful real estate investors in your position. So let's look at the key benefits. An IUL will protect you from market downturns. So unlike direct market investments, IULs offer downside protection. So in other words, when the market declines, your principal is protected by a guaranteed floor. The saying is zero is your hero comes into play because you don't lose anything. In fact, many carriers still offer 1% gain on your money, even if the market's down. There is tax-free growth potential. So similar to the tax benefits you enjoyed with real estate, the cash value with an IUL grows tax deferred. Now, you aren't going to pay taxes on that money, no matter what the gains are, and when it comes time to take it out. The third benefit is tax-free access to your cash value. Through policy loans, just like when you're taking loans against real estate, you do not pay taxes. But here's the difference between real estate and the IUL. The insurance company does not expect you to pay that loan back, although you can. You can take that loan and use it for whatever purposes you need. Typically, our clients are using the money for their retirement needs. However, it's for whatever purposes you see fit. Now, with your real estate loans, you know that money has to be paid back. But with an IUL loan, you don't have to pay the money back because it is guaranteed by the cash value that exists on the ledger, as well as the death benefit, because this is a life insurance contract. So this creates remarkably efficient income in retirement that doesn't increase your tax bracket. You have liquidity without penalty. You have asset protection, and you're not exposed to any required minimum distributions like you might find in other financial vehicles, your 401ks and IRAs. And then, of course, there's estate planning efficiency. This we get into details with our clients depending on the situation. But life insurance, of course, passes directly to your beneficiaries, bypassing probate. And when it comes to handling your IUL versus your real estate holdings, an IUL can be seamless and much less troublesome when you have one financial vehicle that's passing assets to your heirs, or what we like to recommend is setting up a trust. So when structured properly, the IUL provides competitive returns. Remember, the indexed portion of the IUL is tied to a market index. That's one that we choose. Together, we'll look at the indexes of the few insurance companies that we work with who have the best IUL products and decide how we want to allocate the cash value and distribution to different indexes. The second is making sure the IUL is structured properly, because the idea is living benefits. So we want to maximize the amount of cash value that can accumulate and minimize the amount of life insurance that is part of the contract. So the mechanics of the IUL can seem a little complicated, but that's why we'll sit down with you in your financial peace of mind strategy session, and I'll show you how the IUL actually functions for those living benefits to maximize that cash value. I'm John Havey with Life Legacy. Contact me today for a no-cost planning session, and I'll show you a custom illustration tailored for your needs.